Tariffs were meant to be a tool of economic power, a show of strength designed to protect American industries and put foreign competitors on notice. Instead of reviving domestic manufacturing or securing economic dominance, they've unleashed a financial disaster so profound that the U.S. stock market lost $4 trillion in value in a single day. This wasn't a random market fluctuation, but a direct consequence of a tariff war spiraling out of control, leaving businesses scrambling, investors panicking, and the United States, rather than its foreign rivals like China or Canada, bearing the brunt of the damage. What started as a strategy to fortify America's economic standing has morphed into a self-inflicted crisis, draining wealth faster than any foreign adversary ever could. But how did it all come to this? The first target in Trump's tariff offensive was China. The plan was straightforward: raise tariffs on Chinese goods from 10% to 20%, making Chinese imports more expensive for American consumers and forcing companies to shift production back to the U.S. The administration believed that applying economic pressure would leave China with no choice but to comply with American demands. However, China responded with calculated precision. Rather than folding under the pressure, Beijing struck back by imposing heavy tariffs on American agricultural products, a devastating blow to the backbone of the U.S. economy. Suddenly, American farmers who relied heavily on exports of wheat, corn, soybeans, and poultry saw their largest customer walk away. Demand plummeted, shipments stalled, and the very people Trump had vowed to protect were now watching their revenues collapse. As farmers struggled, Wall Street descended into chaos. The tech sector, long hailed as the driving force behind the stock market's growth, was among the first to take a hit. Companies like Apple, Nvidia, and Tesla, all of which depend on global supply chains, Chinese consumers, and stable trade relations, found themselves in free fall. The Nasdaq plunged 4% from its previous high, dragging investors down with it. Tesla alone lost $125 billion in value, a staggering blow that revealed just how vulnerable the market had become under the weight of rising trade tensions. But the damage didn't stop there. Investors, still haunted by the memories of the 2018-2019 U.S.-China trade war, saw the warning signs. Back then, tariffs had disrupted supply chains, forced companies to raise prices, and slowed global economic growth. Now history was repeating itself, only with even higher stakes. Businesses, uncertain about Trump's next move, began slashing investments, freezing expansion plans, and hoarding cash rather than hiring workers. The ripple effect was unmistakable. Confidence in the U.S. economy was evaporating, and the fallout was just beginning. Yet China wasn't the only country caught in Trump's crosshairs. Canada, one of America's closest economic allies, found itself unexpectedly targeted. Trump imposed a 25% tariff on Canadian imports and added a 10% tariff on energy exports, expecting Canada to back down. Instead, Canada delivered a powerful counterpunch by slapping a 25% surcharge on electricity exports to the U.S. This single move sent shockwaves through the American energy sector. Almost overnight, the cost of electricity for U.S. manufacturers surged, making it more expensive to produce goods domestically. Far from protecting American industry, Trump's tariffs ended up driving costs even higher, pushing domestic manufacturers into an even weaker position. The corporate fallout was swift. Delta Airlines, one of the largest carriers in the U.S., announced that its profit forecasts had been slashed in half, citing the economic uncertainty caused by the tariffs. The news triggered an immediate sell-off, with Delta's stock plunging 14%. It was clear that companies weren't just worried about short-term losses. They were fundamentally rethinking their long-term strategies in an increasingly unpredictable economic environment. The market-wide collapse soon followed. The S&P 500, which had reached record highs mere weeks earlier, suddenly found itself in a downward spiral. Hedge funds, once bullish on Trump's pro-business policies, dumped their stocks at the fastest rate in 2 years. Confidence in the administration's economic handling unraveled, with the numbers telling a grim story. Every market gain since Trump's re-election had been wiped out. The $4 trillion loss wasn't just a financial blip. It was one of the worst market meltdowns in U.S. history. The sell-off spread rapidly across sectors, from banking to retail to cryptocurrency. Even Bitcoin, often viewed as a safe haven during times of market panic, fell 5% as risk-averse investors rushed to pull their money out of volatile assets. Bond prices soared as panicked investors sought shelter in U.S. Treasury securities, driving the yield on 10-year bonds down to 4.22%. When investors prioritize safety over growth, it's a sign they're bracing for recession. And that's exactly what's happening now. Despite the economic carnage, Trump's administration showed little concern. Some insiders even suggested they were comfortable with a market downturn if it meant advancing their broader trade agenda. But this wasn't just about trade negotiations. It was a full-scale collapse of confidence in the U.S. economy. Without trust, businesses don't invest, consumers don't spend, and economies don't grow. Even more alarming, Trump's strategy lacked any clear exit plan. There was no contingency in place for economic retaliation, no understanding of how global markets would react, and no diplomatic groundwork to prevent further escalation. What was sold as a bold plan to protect American interests was, in reality, political posturing disguised as economic policy, and the consequences have been devastating. Markets thrive on stability, confidence, and long-term security. The $4 trillion wiped from the U.S. stock market wasn't just a loss of wealth. It was the market's brutal verdict on Trump's reckless experiment. The repercussions extend far beyond Wall Street. When businesses shrink, jobs vanish, wages stagnate, and consumer spending plummets. Recessions aren't born from numbers on a screen. They arise when economic trust is shattered, and that's precisely what these tariffs have done. Perhaps the most chilling aspect of this entire debacle is that the damage is self-inflicted. Other nations aren't waging economic war on the U.S. They're simply responding to an American policy that's backfiring spectacularly. China has not only absorbed the initial shock, but has used it as motivation to fast-track its transition into a self-sufficient technological powerhouse. Meanwhile, America, driven by short-term financial markets and volatile political cycles, is the one suffering the immediate consequences. Without a clear plan to de-escalate, the longer these tariffs remain in place, the more American businesses will falter, consumers will feel the squeeze, and the damage to the U.S. economy will become permanent. What began as a strategy to assert dominance has transformed into a reckless gamble that's unraveling America's economic stability. The only question that remains is how long this self-inflicted crisis will continue before the American people reach their breaking point, and whether Trump will be forced to act before it's too late.